One of the things you've mentioned is you feel like PropTech is not the most suitable term for this kind of array of new companies and solutions that are out there and what we today call PropTech. Why do you say that?
So I wrote a letter about a year ago called PropTech Needs to Die. And PropTech was in quotes because I meant the term PropTech.
Right.
I'm a big fan of the role of technology in real estate by and large, but the term PropTech encompasses a bunch of different things that really don't have a lot to do with each other. On one hand, you have basically vertical software as a service businesses, companies that are selling a software tool into real estate owners that might increase efficiency, might generate more revenue.
SaaS for the real estate industry.
Exactly, and that's just vertical SaaS. And in theory, any venture investor who does vertical SaaS can totally bet on those companies. On the flip side, you have, I would say, much more complex, much more capital intensive businesses that touch the sticks and bricks themselves. A lot of climate tech fits into this category. A lot of new operating models like short-term rentals fit into this category. And those two business lines, from a financial standpoint, from a return standpoint, can both be great businesses, but they don't have a lot in common in terms of their trajectory, in terms of their capital needs, in terms of their leadership and talent needs. And so bucketing them all into PropTech, I think, is doing both categories a disservice. And what I was arguing for was to really segment those out and to have, and look, there is a robust set of venture investors who can bet on vertical SaaS. It is a lot more complicated to say, here are the sources of capital for innovative real estate operating models, for climate tech, where you need to invest billions into actual physical modifications of space. That's a lot more complicated to figure out how you finance that. And venture can play a role in that, but it may not be the full solution to the problem here.
And I think to some extent people have learned a somewhat false conclusion from the stories of like WeWork, for example, where they were like, oh, this was never a tech company. And it's like, well, yeah, obviously it was never a tech company. This was a new approach, a new business model to the commercialization of space for knowledge workers based on a whole bunch of secular trends that we're seeing, the shorter leases, miniaturization of space, on-demand space, et cetera. But to your point, it's almost like venture capital tried to cast these businesses as venture capital ready companies to invest in because they could generate a 30 to 40% IRR. But the reason they couldn't, or the reason it feels like their risk profile showed itself, is that they were far more cash consumptive than a capital light, capital efficient, vertical SaaS business. The answer to that, as I've always heard, is that we should build a lot of Propco-Opco funds. And you look very closely at this space and you have a lot of experience with this. Why do we not see more dedicated Propco-Opco funds that can commingle venture-like risk in an emerging real estate new business model and hard asset capital, the actual real estate capital that's required to accelerate its growth?
Yeah, so just so people know what we're talking about, Propco-Opco is this idea that you have a potentially venture scale operating company that is asset light, that maybe they do the management, the technology, et cetera. But then you have a separate company, a Propco, that actually invests in and holds real estate assets. And a Propco could be any kind of hard asset owning entity. It doesn't even necessarily have to be real estate. I know an investor who set up a Propco to do parametric insurance contracts separate from a venture-backed opco. So you think about this Propco-Opco model, and it makes a lot of sense, and there's a lot of interest in it because of that. You're segmenting the high-octane, expensive venture dollars from capital that wants exposure to real estate. But you've seen relatively few of these formal funds actually emerge, and there's a number of reasons for that. One is it's complicated and hard to do.
It doesn't fit in a box.
Doesn't fit in a box. And as an entrepreneur, you're turning one fundraise, raising your venture round, into two fundraises. You're raising your venture round and you're raising your Propco. And that can be really hard to do. That's a real challenge. You also have seen a lot of companies say, hey, wait, I don't necessarily need a Propco fund. I just need Propco capital. So you have companies like Placemaker, for instance, that have decided intentionally to go deal by deal and lock up a building here, a building there. I mean, they're writing, $20, $30 million equity checks, so they're doing larger deals, but they're doing them on a one-off basis.
With discrete sets of investors.
With discrete sets of investors each time. And therefore they look a lot like, in many ways, a typical real estate GP, except shared brand, shared technology with the OpCo.
So one of the obvious questions is, and I'm sure you appreciate the same point, it seems so natural, so intuitive to me that to truly capitalize on these new tech-enabled real estate business models, you actually want to be deploying both kinds of capital, but ideally conjoining them from a returns perspective, meaning there's a huge dependence on being able to access real estate capital for these new operating businesses. And conversely, the value of your investment in that operating company is so dependent on being able to mobilize huge amounts of lower return, lower risk, capital intensive dollars that are going to come from the real estate sector. And yet for some reason they're divorced from one another. There's this bifurcation in the market. Is it just that LPs haven't gotten their head around that this is such a clear and obvious opportunity and it's so idiosyncratic to real estate as a capital intensive industry combining with tech, which is a capital efficient industry?
I do think a lot of it comes down to LPs and the fact that these are very, very different buckets of capital at any institutional investor. Their venture team sits way over here and their real estate team sits way over there, and they think in very different ways. And nobody wants, at an LP, one side to be benefited over the other. So you end up with a lot of real governance challenges in these OpCo-Propco structures. Certainly if you're an investor doing both OpCo investing and Propco investing, that it really is a win-win and you don't have one side subsidizing the other. And unfortunately, in a lot of these categories, there aren't off-the-shelf, obvious, benchmarked management fees, brand fees, technology fees that clearly delineate the economic returns of the OpCo versus the Propco. It requires a lot of original thought, and a lot of structuring, and a lot of brain damage, frankly, doing this. And so you've seen a few people do it. A few investors go out and say, hey, we have a pool of OpCo capital, we have a pool of Propco capital, but they have to be very, very, very thoughtful about how they do it. There's one firm, Alpaca, I spoke about last year that looks at their real estate arm as quite independent of their venture arm. The real estate arm goes and acquires real estate assets based on a thesis that they believe in. They're doing EV charging, for instance, is one of their themes. And then they go and find an operating company or two that they believe using technology could enhance that thesis. And then they have kind of an inroad to doing a venture investment. But the connection is very loose. Even though they have OpCo and Propco capital for governance reasons, they really don't tie it together that tightly. And you look at other firms like Bain, for instance, they have a bunch of Propco capital. They do a lot of venture investments. There's effectively no connection between the real estate investing and the venture investing at a firm like Bain.
So in the real estate industry, there's a long economic history of different asset classes starting their lives as tech companies, but then ultimately becoming real estate businesses. Data centers, you have single family rental, you have the tower business. What it feels like is that the real estate industry and real estate capital comes along later in the evolution of that sector and really grows and scales it. But that's kind of a miss, because ideally that should be done at the beginning. That should be done with co-working and co-living and short-term rental, this conjoined OpCo and Propco capital. And it feels like this is in some ways the missing link that could truly accelerate some of these sociological changes that I think probably both of us are predicting around how asset classes are going to morph together.
You have to be, I think, doing that very thesis driven, if you will,
right.
In that you have to pick specific areas that as an investor, you believe are going to see just holistic returns. because that way, that's the solution.
It's a total return strategy.
It's a total return strategy. You have to be vertically integrated here. That solves the governance problem of, well, how do we balance between the OpCo investors and the PropCo investors? You have to be focused. You have to share investors between the two. And the closer you can get to being one entity, the better.
Who's going to do that?
You know, it's hard to say from this vantage point. I mean, you've seen a lot of institutional capital pull back over the past 18 months. So it's hard to look at the institutions and say that it's going to come from there. I think the best people to do it today are going to be venture investors, people who know how to think innovatively, who have strong relationships with their LPs, who understand the long haul, who understand that real estate wealth is built over decade-plus horizons, not 3 to 5 years.
It's just hard because one of the things we said at the outset of Fifth Wall is that if you look at the venture capital ecosystem, almost none of the general partners at big venture capital funds have ever worked in real estate. For some reason, it's the industry that never seems to cross with venture. And conversely, almost no one in the real estate industry comes from venture. So what it requires is a certain dexterity in being able to understand the risk return profile and the capital intensity of hard asset built world investing with tech-enabled services and technology businesses. And there's just a handful of people on planet Earth that actually can do that. And I feel like the absence of those people is really where the core problem stems from, which is no one can, in a very facile way, speak to the real estate world about their risk return profile and also speak to the tech world about their risk return profile.
And you do have firms that almost look like multifamily offices that start to do some of this sort of thing. Iconic is probably the best example of a firm that did a true OpCo-Propco structure with Central, a short-term rental operator. Well, another would be Sequoia actually has a large real estate fund in Sequoia Heritage that manages the family office capital of the partners, doesn't really have a tight relationship with the venture investments from Sequoia itself. Different investors after all.
Right, and different return profiles.
And very different return profiles.